Okay, let's do a sound check real quick. I'm obviously starting a little early because we're doing the YouTube live stream once again. Let's see. Test 1, 2. Okay, let's see. Excuse me. Hey, Jeff, can you hear me? Thank you, Jeff. Appreciate it. I'm inviting more people. Okay, to those who are watching on YouTube, we normally start at 6 Central. Hey David, good to see you, buddy. Yeah, we should have sound. Fantastic. How are things in Oregon? Thank you, Steve. All right, we'll get started in about 5 minutes. Winter is coming. What part of Oregon are you in? Are you near Bend? Oh, it's actually live for my YouTube friends. Yeah, we go live every Thursday at 6 p.m. Central Time, 7 p.m. Eastern. Gotcha. Dave, do you know Charlie Kirk? Did you hear about what happened? He's nearby you. He's near you. Yeah, to those on YouTube, I don't know if I'm gonna phase out, go to webinar or not. Probably not, just because it's intertwined and interconnected with a lot of other things. But I am experimenting with the simulcast from the GoToWebinar. It seems to work okay. Okay being a keyword in that sentence. But yeah, we'll get started in a couple of minutes. If you guys want to ask any questions going in so I can answer them during the webinar, just let me know. He's in Ben. Yeah, he's been around forever. He's a great trader, great guy, great analyst. He puts out the Kirk report. He had a really bad accident. Not to start the show on a low note, but a bit of a bummer. There's some information on my website on it and the GoFundMe page and everything, davelandry.com on the homepage now. Okay, about 1 minute out. Hello, everyone. Dave Landry here from davelandry.com. This is the week in charts. Obviously, I want to thank all you guys and girls for attending. I appreciate you taking time out of your busy schedule to be here. All right, what are we going to talk about? Well, obviously, current market conditions. I'm going to have a lot to say about that. Your questions on trading, feel free to type them in chat. If you're on YouTube Live, give me an extra minute or two to catch up with you because I'm actually simulcasting from a different product, and it takes me a while to get to the chats. But I will look at the chats, especially before we wrap things up. Your favorite stock and crypto picks, hold off until we get to the live charts, which I'll let you know when that happens, obviously. And one symbol at a time and just hit return. That way I can cover a ticker and then move on. So what are we going to talk about tonight? What are we going to focus on? Well, charts on a chart show. What a concept, right? I want to talk about the TFM 10% system. We could actually have a buy soon, which is kind of odd, but maybe not with today's action. So we'll get to that in just 1 second. Crypto is heating up, and we're kind of in that just buy stuff that's going up mode, and that's the most exciting and fun. I know trading's not supposed to be fun, but that's the most exciting thing with crypto. And then after we get a run like this, then we can go back to using the core methodology with things like Landry-like pullbacks and just generic stuff like that. Q&A, just feel free to type your questions in. And here's a plethora of ways to reach me. I've left out a few here. X is at T following moron, TikTok trend following moron, YouTube at Dave Landry. There's a disclaimer screen. As you know, you can lose money trading, or as I often sum it up, all predictions are about the future. Right? A lot of stuff can happen between now and then. I stole it from my buddy Greg Morris. All right, I want to go through a couple of charts real quick, and these are charts that I showed in my Trading Simplified show this week. This is LFMD, and the indicator on the bottom, or as I like to call it, illustrator on the bottom, counts the number of bars that the low is greater than the moving average or the high is less than the moving average. If the price bar intersects the moving average, easy for me to say, then it resets to zero. But you can see that coming into this trade, we had about 45 days or so of the upside Landry light, and it pulled back to the EMA. And this completes the Landry light pullback. And just because you have a setup and the Landry light and all this good stuff doesn't mean you want to take the setup. What you want to do is you want to look to see if you have structure in the chart. In this case, we had a stock that was accelerating higher. It was persisting. Notice that it goes up day after day after day after day. And as I said, my stock charts show this would be a textbook type of example to show. In fact, a lot of times I'll show setups that worked great like this, and people say, well, you cherry pick that one. Well, I cherry pick all my trades. And that's one thing that I talked a lot about in yesterday's Trading Simplified show. Anyway, so we got a Landry light pullback. Here are the parameters here. If you want to look at these in hindsight, you can go to davelandry.com/archives, or you can become a member of the service and watch them in real time if you want. But there's the parameters: entry, protective stop, IPT. and it's a Landry-like pullback. And if you need this spreadsheet, I'll give it to you. It's a blank spreadsheet, so you can put your own trades in if you're following a methodology similar to mine. So it triggered here, right at this level here, and you can see it kind of backed off immediately, and then it kind of turned into dead money for a while. Now, one thing that's kind of interesting is, in perfect hindsight, the top of the market was on July 27th, and after a few weeks of the market rolling over, you might think, well, maybe I should bail out on this. And last week, I showed somebody's Facebook post about just wanting to bail out on everything, and everything kind of took off over the next few days. Anyway, it became dead money, and dead money is obviously a position that has little or no chance of ever making you money. Well, you don't know that, okay? If you knew it was truly dead money, then you should get out. But many times, and the old me too probably would have gotten out, but since I started a trading service 20-something years ago, all I have to do, easier said than done, is just follow along. And it's like, it's painful being underwater for a few weeks or even a month or two in a position like this. But as long as you're not stopped out, maybe the stock got a little ahead of itself. It just needs some time to consolidate. And again, as long as you're not stopped out, you stick with the position. Now, once you hit the initial profit targets, which is the same as the distance from the entry to the stop, and again, the spreadsheet will calculate that for you, you bump your stop to break even, and that way you're free rolling, as Charlie Kirk calls it, after he looked at my money management. By the way, I'll put a GoFundMe link below for Charlie. Charlie had a really bad accident and is not doing too good, but he's improving last I heard. But anyway, help Charlie out if you're able. He's one of the good guys out there. But anyway, you trail a stop loosely on the remainder of the position. We backed off a little bit from when I took the snapshot, but you can see we're now in longer term trend following mode. And the idea is to change hats, so to speak, from the short term swing trader, where the risks are relatively defined and your probabilities are a little bit better of getting a profit than they are with the longer term trading, where your probabilities are really bad, okay? And your risks are huge if you're trying to ride out a longer term position. If you go into a position, I should say, and you're trying to ride out that position for a long time, you're going to have to use a super wide stop. And any of the true longer term trend followers that aren't taking profit and all, and are going in for longer term trends, their accuracy is abysmal. About 28%, you're going to be about 28% accurate. I know statistics are worthless. 74.5% of everybody knows that. But anyway, your accuracy is going to be really bad. Your drawdown is going to be horrible. And I would never be schadenfreude, but that's probably why you don't see a lot of the turtles still running money, because they were trading a breakout system, which is prone to really abysmal failure unless the market's doing fantastic. Like I'll show you crypto now, a breakout system would actually work in crypto at this present time. But they, not to take anything away from them, as I say quite often, they were in the right place at the right time. They did have a little help from Richard Dennis and Eckhart, so that probably didn't hurt the process. Anyway, so this is the stock in the portfolio from a couple days ago. We're up 77%. We backed off a little bit from there, but this is the idea, to catch these longer term winners, and you just need a few of these a year to pay for your year, to pay for all your other losses, and to really make your year. And this is on a hypothetical 100K account, and I do take these trades across multiple accounts, but I do have a model account where I do something very similar to what I'm showing you here, and I often show those trades. I don't know if I have any to show this week, but I have some crypto I'll show you, just some nickel and dime stuff in a minute. But anyway, so that's what the portfolio looks like, and I have similar positions, like I said. Now here's another one. This was an IPO, and with these higher price IPOs, I don't trade the buy at B pattern. I get a lot of questions about the buy at B for these higher price issues, and I found that as a general statement, it works a little bit better with IPOs that used to be $20 a share, and now 20 or more would be the cutoff, but now it's 30 or more. And I find that once it gets higher and higher price, for some reason the buy at B doesn't work as well. But technically the buy at B would have been on this day here, because we closed above the first day high, which was also the high for the week. if this high was down here somewhere, the buy at B would have been on one of these bars as soon as it makes a new closing high for the week. Anyway, without digressing too far, this is an IPO first pullback, and this is a secondary setup. So your pioneer type of setup, or your first setup, however you want to look at that, is going to be the buy at B. If the stock is maybe thin or possibly much higher price like this one was, then you wait for that secondary setup, like a Landry like pullback or just a first deep retracement and an IPO, and that could be a great pattern to trade. Anyway, there's the parameters again, 45.20, 38.50, and you broadcast that up, and the IPT is here. And you can see that it did kind of go sideways for a while, and then in perfect hindsight, this was the market top here. So a few days later, let's say you're underwater in this position, and you're thinking, you know, this thing's not doing so well, the market's starting to tank, maybe I should get out. Well, the best thing to do is just follow your plan. If you get stopped out, you get stopped out. Trading, like life, is making decisions and living with them. And the living with them can be the tough part, obviously, but you just have to say, I am going to stay with this position. And what's going to be my state of regret? Well, I get stopped out. I feel like maybe I could have micromanaged myself out, but I know that's bad behavior, so I'm just going to stick with it. I get stopped out, I get stopped out. Sooner or later, if I'm doing the right thing and picking stocks that look good like this, or textbook setup like the LFMD for more of a core methodology looking type of setup as opposed to an IPO setup, then longer term, I'm going to get paid. Over the short to intermediate term, I will have some losses. It's one of the few things I can guarantee. But anyway, even after the IPT was hit and you're free rolling, so to speak, this thing went sideways for a couple of months. And it's very tempting to get out and think that it's dead money. But again, you don't know that it's dead money. So here's a snapshot from a couple of days ago. You can see we were up 22% on the second loaf on this one. All right, I showed this again in my stock chart show. Oops, wrong chart. Let me just cover this while I'm here. This is out of order, but lately I've been noticing that the Qs have kind of been hanging in there and doing much better than the S&P 500. And what's kind of cool about putting together shows and all is it forces me to do a little research, which I like. And the trading service, for instance, forces me to do a lot of research, which I like, of course. But me, with my ADD, I'm liable to get sidetracked doing other things. But having these obligations forces me to do these things, and that's just how I operate. But anyway, I noticed that the Qs, which I am actually still long 100 shares, which I'll show you in 1 second, have been outperforming the Ps. And I was kind of shocked when I looked at it because I really thought it was going to be a lot better than this. And all you have to do to plot this is just put any symbol in and then a colon and then the other symbol. So this is Qs versus Ps, the QQQ versus SPY. And you can see over the last week or so, the Qs really have been outperforming the Ps, but not as much as I thought they were. But going back in time, yeah, the performance has been really impressive compared to the S&P 500. So when this is rising, obviously the Qs are outperforming the Ps. When this is falling, vice versa. And just by accident, I plotted a Landry light on here, and I just thought this was kind of a cool indicator. I know I'm a nerd, but this is kind of cool to show you that the strength has been really good for a while, and then they're kind of equalized out for a bit, and now once again they're beginning to improve a bit. Okay, let me do a quick update on the TFM 10% system. In case that chart didn't make it, the chart I was going to show was CEIX. When we get the live charts, I'll show you that. So just real quick, because we've gone through this quite a few times, but let me just update you real quick. So this is based on a 50-week closing high. And Jeff, who's here tonight, was telling me about, or mentioned the fact that once a market loses 5% from his 50-week closing high, it's in a bit of a jam, or it's a caution area. And that's why I drew these zone charts to kind of give you this graphical representation of where you are. And in order to plot these, all you need is to plug in ACP. And this is easily created in other packages too. So you just take the highest close for 50 weeks, okay? And then you want 90% of that for the 10% line, which is down here. And then now I'm starting to pay attention to the 5% line, which is right here. So let's take a look at that. So the system uses the 50-week closing high and the 50-week SMA, and that's it. So as a general statement, as long as the market is within 5% of its 50-week closing high, it's in pretty good shape. Okay. Now keep in mind that markets, as Greg Morris pointed out, only make new highs about 4% of the time. So the rest of the time, you're going to have backing and filling. And also, by the way, as a trend follower, you're going to spend a lot of time less wealthy, but the money tends to come in chunks. So it's like you bump along in something like the KNF or LFMD for weeks and even months, and all of a sudden, bam, it takes off overnight. And it's the market's job, by the way, to frustrate the most amount of people. And it just seems like the market sometimes out to get you, but you got to realize that the person on the other side of the trade probably feels that way too. And that's something I don't want to get into a lot of details, but it's one way to kind of wrap your head around your own psychology, and that the market is not out to get you. Okay, it might be out to get half the people, but not the other half. But the market will do a lot of things to shake people out, to frustrate people. And a lot of times, and this is a corollary to that I got from Linda Rasky, and she said she got it off the floor or wherever. But the corollary is the market will often do the most obvious thing in the most unobvious manner. If it's rolling over, it might have one little last rally after it begins to roll over to make it look like it's going back to new highs, and then it'll roll over, or just various other things like a TKO is actually something that takes advantage of that, a trend knockout, where the market's in a really, really nice trend, and before it decides to go higher, it has this big knockout move to frustrate some people, to shake some people out, to suck in some shorts, and then you can take advantage of the predicament of these traders by trading the TKO pattern, obviously. Anyway, getting back to this, as Jeff pointed out, once you dip into that 5% loss zone, between 5% and 10% losses, or 5% and 9.9% losses, you might want to think about exiting the market. Now, I did some just kind of quick empirical type of research based on that, and I think you would get probably too many whipsaws if you tried to trade it like that. But I do think it is a viable indicator to let you know that the market might be in trouble once you start getting into that caution zone. And then obviously, once you lose 10% or more, that's where bad things tend to happen in the market. At any momentum type of indicator, my stuff or anybody else's stuff, momentum base, it's not, my stuff, I'm not saying it's better than everybody else's, because anything that shows weakness in the market, which is reflecting weakness in price, okay? And if it's showing weakness, then bad things tend to beget more bad things. And 10%, the way I came up with 10% is I figured if a market is going to lose half of its value, as it does fairly often, more often than it should on a statistical basis, as you should know, or likely know, I should say, markets are not normally distributed. If they were, then whoever had the biggest computers and knew the most about statistics would win. But obviously, it doesn't work that way. But anyway, the way I came up with the system was I figured if a market's going to lose half of its value, again, as it occasionally does, it's going to first lose 10% first. Now, 10% is a good round number for indices like the S&P 500, and it probably could be a little bit wider for the NASDAQ or the Qs, however you want to look at that. But I just find that that's a really good round number for the indices. And individual stocks, I think it would be a little tricky to get this to work, because in individual stocks, this might be 30% or 40% or something really crazy like that. If you look at some of the stocks in the service, sometimes the stops are 30% out. And that's just what the market calls for. And as you know, we just adjust our share size lower to compensate for that more risk. And some people will tell me, Dave, I didn't take that trade. I can't risk 30% of the trade. Well, you're not risking 30%. You're risking 2% of your account, okay? You're not risking 30% of your account, and you're adjusting that share size accordingly. And if you look at my website, I think I sent it out in one of the recent newsletters, but if you go to my website and search for Better Than the Devil You Know or Volatility, you'll get an article where I actually show that less volatile stocks can be more dangerous to trade because you're going to have to put on more shares to capture that percentage move with the stock that doesn't move around much. And then something bad can still happen, like Hewlett Packard for whatever, for example, I should say, for whatever. As I say, for whatever reason, I know the reasons. The secretary or whatever was a soft porn star, and the CEO decided to chase her around the desk, and she wasn't too keen on that. And the company lost a shit ton of money based on something stupid. But I digress. Anyway, bad things can happen. People could do bad things and get in a lot of trouble. And who knows, a war could break out or God knows what. Anyway, the sell signals, once you get below 10% or drop 10% or more away from that 50-week closing high and close below the 50-week SMA, you need to get out of a market. There's no guarantees in trading, as you know. But after I designed the system, looking back like 15 or 20 years or whatever, I went back much further, all the way to the early 1900s. And I found that this system would have gotten you out of every bear market in history. Now, somebody asked me recently, hey, Dave, you got a sell signal last Friday or 2 Fridays ago. And what if we just kind of wait around a little bit and see if the market improves? And it's like, okay, that's fine. But if you're looking at how the system functioned over time, that 10% and drop below the 50 simple moving average, these are weekly charts, by the way, is your sell signal. And in 1987, your sell signal came in on a Friday and the market crashed on Monday. So there's always a danger in waiting for more and more confirmation, as opposed to, as Greg Morris says, take all signals seriously. Anyway, this so far could be a whipsaw, but as Greg also says, whipsaws are frustrating, bear markets are devastating. You could survive frustration. So whipsaw means you get in and you get knocked right out and the system goes long again or whatever, and you lose a few percent in the meantime. But the good news is, if you do get out and then the market crashes, then obviously you don't ride out that market crash. And as I've said 1,000 times, the pandemic, for instance, you could say, well, Dave, that was a whipsaw signal. It's like, but yeah, the market dropped another 30% after it triggered, round numbers. So that's the idea, or the designer's intent, I should say, for the system, is to get you out of the way. Remember, as I preach, market timing is less about beating the market and more about not letting the market beat you. Buy and hold will win if a market crashes and comes right back, okay? Or if a market just chops around, goes all over the place, is in a bear market for half the year, and then comes back to break even or even slightly positive by the end of the year, then market timing will not work. Market timing is not easy, okay? I don't want to make it look easier than it really is, but something simple like this can keep you out of a lot of trouble and certainly alert you to the fact that, hey, everything isn't peachy keen, especially if you're just paying attention to that 5% zone, that little caution zone. That could be a heads up. Now, on the buy side, in order to help avoid being whipsawed, okay, you get a sell signal, all of a sudden the market snaps back. You can have these great bear market rallies, as you probably know. They're very tradable and they're fun to trade, and I love them. But a lot of times the market stalls out and goes right back down. So to avoid getting caught up in some of that whipsaw. And by the way, you got to be careful not put too many whipsaw filters in before you. If you do that, you end up curve fitting. But in this case, I wanted to keep it as simple as possible. And I just kind of mixed an older system of mine, the 220 EMA system, which I now use a 30 EMA with that. You can Google it and get the parameters for that. But anyway, kind of taking that into consideration for the whipsaw filter. And all you need is 2 bars of upside Landry light. Now, this is a weekly chart, so you'll have to have 2 weeks. So you can see that the market snapped right back. 2 bars of the Landry light, okay? So we had bar 1, but obviously we got weak the market became weak by the end of the day or throughout the day. Today, and this is a weekly chart, okay? So for the week, we're down, obviously. But you have one bar of Landry light. It should just stay above 42.02. And then next week, technically, next Friday, we could actually get a buy signal. So we'll have to see what happens. Now, there's a buy signal. Let's see if I can get back to it. There was a buy signal way back here that I didn't see, that somebody pointed out, one of my clients pointed out, because I used a big, thick moving average line. But even though this is a buy signal, I would personally not rush out and buy because the market was so darn weak. In a case like this, I would wait for it to possibly take out the high of that 2-week high. So that's something I learned by watching this thing in real time. And I've been watching it for, I forget exactly when I introduced it, but it's probably been out for 3 or 4 years at least. If anybody remembers when I first mentioned this stuff, just please let me know. Anyway, so 1 week here, but again, if next week we're further down than we are now, as opposed to being up, even if it is a buy signal, I wouldn't take it. I would wait for some additional confirmation. So that's one thing I didn't do when I designed the buys on this, was I didn't design in a strength characteristic. I did as far as the Landry light, but I didn't think about it being a down week and also a trigger. Now, just for S&Gs, I took 100 shares on this last buy. And by the way, this system only catches up to the market if you stay in a bear period for a long time. So you could see each one of these bars is a week. So this was over a year of the market headed lower. And you can see that initially it really didn't catch up to the market, okay? But as the market goes lower and lower and lower over a year or so, 50 weeks actually, then it starts catching up to the market and you get to buy at lower and lower levels. Now, I have other things I watch like daily bow ties and a bunch of other good stuff, Landry light, etc., on a daily chart. So I'm not necessarily sitting around and waiting for a weekly buy. But there was a weekly buy in this particular case because the market, or the indicators, did catch up to the market by dropping over time, okay? And the moving average dropped too, obviously. But you can see we have 2 weeks of Landry light, so it's buy market on close. And I got in at 319.49. It looked like we're gonna have a signal on Friday. I think I got in about 2:30 or so, about a half an hour before the market closed. Now, in order to sell this, it would have to close 10% or more away, which would be 344.63 based on this 50-week closing high here. So it would have to close, I'm sorry, it would have to be above that, and you need two. Let me rewind this. In order to sell, it would have to close below this moving average, and it would also have to close 10% or more away from its 50-week closing high, which is right here. So anywhere in this dark pink or red area would be a sell, provided it closes below this moving average, the 50-week moving average. Now, this is kind of hard for me to hang on to. Years ago, I tried some mechanical testing, and I did a shit ton of mechanical testing. But as far as the mechanical trading, I'm much better as a discretionary trader than a mechanical trader, but I just thought it'd be fun to put 100 shares in something like this and see what happens. But it's going to be kind of hard to let a 60-something point gain evaporate down, but at least now it would be about 11 point or 12 point gain if I got stopped out. So hopefully this will continue to catch up to the market and get me out a little bit higher when the time comes. But one thing I didn't do, something that you might consider, is maybe putting some money management into this, where you exit half and maybe even get that stop up to break even fairly early on. But as far as mechanical systems go, the great thing about a mechanical system is it does give you an objective way of looking at things, okay? So there's no questions. You're either in sell mode or buy mode. And by the way, if you are in sell mode, just because you're no longer in sell mode, if the market rallies back up a little bit and it doesn't trigger a buy entry, that doesn't mean you should buy back in. if you tried to do that, you'd end up chasing your own tail and you'd have a lot of whipsaw. But anyway, that's where the sell would be. Without going into a lot of details, this is just the diaper change over here. And this is how far the system has dropped after you exit. So remember a little while ago, I said pandemic, 30%. So it was 28% drop after the pandemic. Now the market made all that back and then some. It was one of the greatest periods ever after the market bottomed out, that spike bottom we had during the pandemic. Things really improved and were great. But not losing an extra 30% of your retirement would have been a really good thing. Now, don't rush out and trade the system. I'm not a registered financial advisor, but if you're interested in studying the markets, I think this is a good place to start. And I have a few people that I really respect, and they've told me that, Dave, this is as good as anything after looking at a lot of other systems and a lot of other things. I did get this tweet. I'm becoming a little more active on Twitter for what it's worth, or X as they now call it. So I'm at T following moron. That's me. And this gentleman said, since 1982, 60% sell signals were followed by a drop. 60% of the sell signals were followed by a drop of 10% or more. I went back to 1929, I believe, or 28. And that does hold true right around 57, 58% of the time. Now, there's no guarantee this last signal will cause an additional 10% drop, or there will be an additional 10% drop, I should say. But it's good to know that that tends to happen. It does have that tendency. And that sort of confirms what I was saying earlier as about once bad things begin to happen, sometimes that begets more bad things. All right, let's talk about the VIX real quick. The VIX only matters when it matters. And this is a post I put out yesterday. So I said the VIX is stretched, and I'll show you what I mean by that in 1 second. So look for a bounce in the VIX and sell off in the Ps. The VIX research years and years ago, geez, I'm going to date myself here, 1994 or 1993, I was working with Larry Connors, and I was doing a lot of system programming, and I'd program my own systems. I program his systems, and then I did a lot of, Larry liked me. He said I was a gem because I would take his stuff and then see if I can make it better or tweak it and make it work to begin with on things that didn't work. So anyway, I learned from Larry that the VIX tends to revert back to the mean. So I took him literally on what he said and started using a moving average, which is a mean, right? An average is a mean, same thing. And then look for stretch situations. And I forget what system it is, but I guess as of today, because the VIX closed higher than it opened and it's 10% or more away from the 10-day simple moving average, that would be a sell signal. Buy the VIX, sell a piece. And so that triggered today. Now I did short intraday and I exited by the close. I'm not a big fan of pure short-term position trading because bad things could still happen. So let's say you get short today, you're feeling great about everything, and then tomorrow something happens and the market goes straight back up. Well, the problem is if you're a pure short-term trader, you're not going to make enough. You're not going to catch that occasional longer-term trend, knock on wood. Come in like LFMD or the KNF trade that I just showed. But anyway, it does help to pay attention to this. And if you get 10% or more away from that 10-day simple moving average, and keep in mind that the VIX normalizes itself. So 20 might be normal for a while and 10 might be normal for a while. You can't use absolute numbers. I know Larry Connors used absolute numbers early on, and that stopped working because it didn't normalize to the market. And that's where the moving average came in and began to help things out. And I think Larry used oscillators and other things too. Anyway, down here, this is the close. We're taking a look at the close and seeing how far that is away from the 10-day simple moving average. And we're looking at yesterday's close and yesterday's average. So today's numbers don't factor into that, okay? But anyway, you can see that we're now beginning to revert back to the mean a little bit from this 20-something% stretched, okay? And now we're going to go back up. and getting close to that moving average. So that's going higher and the market goes lower. As a general statement, if the VIX is going up, the market is going down, and vice versa. Now, once it gets stretched to one extreme or the other, you begin looking for a reversal in the market. The VIX is a measurement of fear. It's the at the money options 30 days out, hypothetically. It's a big old fat derivative formula about that big. I don't understand formula, but I can tell you what it does. I don't understand electricity either, but I can flick on a light switch and get some. Actually, I was an electrician's helper for years. My dad owned an electrical service business, so I know a little bit about electricity, but bad example, but you get the idea. It's a 30-day, it's always 30 days, it's always at the money. It's puts and calls, and it's looking at the implied volatility. And people are buying up options when they're in a bit of a panic mode, spiking those prices higher, those IV prices, okay, as measured by IV. And then when the market is just kind of bumping along and kind of like the little man on Price is Right, you know, doing that, then the VIX just kind of begins to die out a little bit. So anyway, that's what's happening with the VIX. We have a sell signal going in, and this is the VIX here, and then the green is the S&P 500 for what it's worth. But you can see that when it gets stretched one way or the other, the market again tends to revert back to the mean. And it only matters when it matters, okay? So if it's just chopping around the moving average, then forget about it, don't worry about it. But when it gets really stretched, you really want to pay attention to what's happening in the market. All right, let me shift gears, go to crypto. I have a lot to say about crypto this week. One thing that I had hoped for, as I said before, when Bitcoin came on the scene, was that Bitcoin could trade independently of stocks. So if we got into a questionable market like we are now, then maybe Bitcoin would still be going up and we could just buy Bitcoin, and that might be a good trade. Would use stops and everything, obviously, but maybe not focus so much on stocks and put some of that money to work at Bitcoin and then come back to stocks when they improve. Well, unfortunately, that really hasn't worked that well. But again, if you put a ratio chart in recently, it actually has begun to work fairly well. The correlation used to be pretty high. You can see like right here, just kind of bumping along. And then it did drift a little lower and finally began to implode a little bit. So Bitcoin began to underperform stocks. And now Bitcoin is outperforming stocks by quite a margin. So I find that kind of interesting. And once Bitcoin heats up, all the SHYT, the shit coins, they tend to follow suit, and that's where the real money is. And I'll show you that in 1 second. Now, Ethereum has been weaker than Bitcoin for a long, long, long time, but now it's beginning to wake up, and now Ethereum is beginning to take off a little bit. So that's certainly a good thing. So here's a trade I took recently, and with the crypto, when it heats up, when being a keyword in that sentence, you can just simply go in and do a relative strength sort. You can do it in stock charts, you can do it in trading view, and I'll show you how to do it here in just 1 second. Excuse me. But you could just buy markets sometimes when they're going up. So that's what I did in this particular case. It's also probably something like a 230 EMA buy or some other stuff. I guess that would have been back here a little bit. But sometimes you can just buy the strongest pairs. In this case, I put in an IPT at 1.2 or 20% higher than my entry. And that would be right here. So it rallied up and hit it. When that happens, you take off half and then your stop goes to break even. And then just like you would with the core methodology, you continue to trail the stop higher. The great thing about these shitcoins is they just could go up 100% overnight. They can go down a lot too. Don't get me wrong. It's very, very risky. And that's why I'm just kind of messing around a little bit with small share size. It's only put $1,000 into this thing, so no big deal. But if it begins to pay off, and I think I showed one last week that triggered and hit within 1 day, and if you're making a couple $100 in a day, that's not bad, even trading small size. but I wouldn't bet the farm with this stuff, and it's all probably BS. So I don't want to. I'm not going to be the person who will defend it. I will say that I think Bitcoin might have a little merit. I may have drank a little bit of the Kool-Aid there, but I trust any market as far as I can throw it. And I am a trader, so I will use stops and I will get outs of the way. Anyway, so in this particular case, again, your stop goes to break even. And I think on that one now I have a little bit higher. And I want to show you this one. This is a little frustrating. Let me see where it is now. This is one that was kind of going straight up. And you can see I got long there. Let's see where it is. Nope, it's backed off a little bit. But it came really, really close to the initial profit target. Now, I'm not one to split hairs. If I'd have seen this happen, this could have probably happened in the middle of the night. So maybe that's why I didn't see it. I would have gladly taken profits, especially one day into the trade. So don't split hairs, but that was the IPT, and it came really, really close before backing off. Now, what I would recommend you do, and I often forget to do, is put some alerts in, maybe put alert in somewhere within a point or two from that IPT to let you know that maybe a little action needs to be taken. So again, got in here, missed that IPT, which is a bit of a bummer, and now it's come back in a little bit. So I just want to show you that it doesn't always work, obviously. So this one was a little bit more of a core type of setup. You had a nice thrust higher off of major lows, and then a little bit of a pullback, almost a Landry-like pullback. And I front ran it a little bit. Technically, I probably should have gotten in right around here. But sometimes when crypto is really, really moving, you can front run things a little bit. But you can see I was able to get that IPT out. I don't have this one on the screen. We'll take a look at it in just 1 second. And then it came back in, but the stop is now at break even. So we'll see how it shakes out. All right, so let me hop into the live charts. We'll do crypto first. If there's any crypto pairs you want to look at, let me know. I just want to kind of show you a couple things in crypto. And then we'll get into stocks, obviously. Okay, so I think that it looks like they just rolled the pair. So this is going to make it, I wish there was a way to roll, have it roll at a different time. But they always seem to roll right when I begin the show. But if you just sort by the strongest, and in this case, you can see these long tails in here. So this one is probably too thin to trade. That one has a lot of long tails, so it's probably too thin too. But sometimes you can just go through these. Like that looks okay, believe it or not. And you could actually buy, and I know it's kind of crazy, you just buy these things when they're kind of going straight up. Let's get rid of that one. But yeah, this is the wild, wild west. These things are crazy, so consider yourself warned. Don't bet the farm. But when the market's really blowing and going, again, sometimes you could just sort by the strongest. And again, this market just rolled over, so you're not really seeing the really, really strong stuff. But you could just get in the strongest pairs and then take the IPT out and trail a stop. So here's that ILV, which is doing okay, but again, we came really close. You know what I'm gonna do right now? I'm gonna practice what I preach. Let me put an alert in here. So I'll put an alert a couple of points away from the IPT, and if it gets there, I'll look to lock and load. This is another one I'm long, AXL, and it's not doing a whole lot from where I got in. I'm also long Matic. You can see stalling out a little bit. Flowed. You can see these are just kind of going straight up. And this is one that I took partial profits in because it did hit the IPT. Where did I get in this one? 0.51, okay? So the IPT, just round numbers in my head, around 60 something cents. And now we're at break even on that, so we'll see what happens. Now here's Bitcoin. Bitcoin coming off a little bit, but you can see they had the mother of all rallies today. GBTC has been taken off. I think that most of the discount has come off. If somebody wants to Google the discount, I've seen discount as much as 40% on that one. But now that it looks like they're getting a little closer and closer to making an ETF, it's come way off. You probably want to party with me, but that'd be a fun chart to do. Is Bitcoin $ BTC USD colon GBTC. Let's see what that looks like. Now here's another one. This was the one we talked about a minute ago. Hit the IPT, and then I'm long CHZ. Now that one hit IPT? I don't think so. But yeah, I'm not sure why I didn't stop out on this one. Maybe I didn't have a stop in place. But this was not doing so hot, so maybe I need to get out of that one. And here's the thing too. I don't believe in micromanaging, but with these pairs, when they're moving, you're playing the relative strength game. Relative strength just a change in price, not relative strength like a momentum indicator. And you just want to be in the strongest pairs with a few caveats, obviously. But then let's say you've got one that are performing and you've got something that you really want, you really like instead, you could get rid of that one and put a new one in its slot, so to speak. Now, it does sound like I'm teaching you bad behavior, but this is a separate type of methodology in and of itself. And if stocks were like 1999, you could do that. And I had a client, and I don't want to exaggerate, I know he's done it twice. He's played the relative strength game like using my Landry list when the market is doing amazing, and he was able to make 2 down payments on 2 commercial properties by doing that. So I don't want to suggest that you could do that easily, but if we get into a rip roaring crazy bull market, then you can. And crypto heats up and cools off, and right now it's start kind of heating up again, and you can go here and do this relative strength trading. Longer term, I'd much rather do just the core methodology type of trading with crypto. But when it's really blowing and going, again, you can come in and make a lot of money really fast with this RS trading. Now, you also lose a lot of money too, so don't get too excited. Okay, let's not start kissing each other just yet. But if you pay attention when it's heating up and cooling off, then you'll be able to go in and play the relative strength game. All right, any questions on crypto? Any pairs you want me to look at? Let me check YouTube to see what's going on over here. Looks like everybody's good. Thank you guys for attending. Appreciate that. All right, let's shift gears and talk about stocks. All right, let's start with the P's. So S&P 500, we have an outside day down. That's kind of bearish. One thing I didn't like with the S&Ps is we kind of wedged higher in here. And when the market starts making marginal new highs or even all-time highs and starts to kind of wedge higher, Bitcoin kind of did that a little bit, but fortunately took off from the wedge. It doesn't always work, obviously, but kind of a gradual sloping upward wedge is actually a bearish thing, and a gradually sloping downward wedge like a cup and handle, the handle of the cup and handle, is actually a bullish thing. It's a little counterintuitive, but I've seen it happen many a times where you get this dull drifting market higher and then it gets whacked a little bit. You can see we had a nice little down day today. Nice because it for the most part just went down. As good as a trend following moron to be able to just kind of follow it lower. Retail got whacked pretty hard today, as you can see. It's kind of all over the place. I wouldn't rush out and try to trade it, but it did get whacked while we're down here. Just take a look at that. Take a look at the NASDAQ. NASDAQ also outside day down. So this might be another one of those things where the market's going to roll right back over, but what's going to happen first? It's going to rally up and everybody's going to be happy. A week or so ago, or right before Halloween, whatever, we had a pumpkin carving contest at the house, and nobody ever asked me about the market unless it's gotten annihilated. And everybody want to know about the market. And then I guarantee you, they're all still long, and they're all right now, today, notwithstanding, breathing a sigh of relief, like, oh, everything's fine. It's going to go right back up. And if it does roll over, it's going to put pressure on these people. And one of which is retired, and she's very concerned about her money now that she's retired. Russell 2000 got whacked in here today. Russell's just ugly, or the rusty as we call it sometimes, selling off fairly hard, down, what's that, 1.5%, weakest of the indices, I do believe, but it's just an ugly chart. Now, energies, they were up a smidge today, but well off their best levels. You can see they've topped out in here. Somebody was saying it's interesting we didn't get a lot of longs on the way up. Well, it's kind of electrocardiogram, okay? And then we did have a bit of a trend here, and then there were a few longs, but look what happened. It pulled back, it took off, then imploded, took off again, imploded again, and so this is not the most beautiful market ever for a trend follower. And commodities can be choppy and tough to trade for what it's worth, and that's it didn't disappoint. But now it looks fairly toppy in here. Let me see if I have bow ties handy. Yeah, you can see the bow ties. Yeah, the bow ties are now in downtrend proper water, and they're below the 50 simple moving average. And they came through the moving average fairly quickly or at a sharp angle. And when you see that happen, usually that tells you that a market is in trouble. Let's see, it really didn't do it in NASDAQ. It's kind of all over the place, but you kind of get the idea on that. As you go through these sectors, sector after sector, in these longer term downtrends have pulled back a little bit, like durables, for instance, got whacked today. Take a look at drugs. Drugs got whacked really hard today, down over 2.25%. So that's not a pretty market at all. Take a look at biotechnology getting whacked in here, down well over 3%. And you can see that lots of Landry light, meaning the highs are less than that 50 simple moving average. Health services, longer term downtrend intact, so far pullback and now beginning to roll back over. Now you would think, by the way, that we'd have shorts coming out the yin yang, and we don't. And the reason is it's because the market sold off, it went up, it sold off, it went up, it sold off, it went up. And you've got this Jackie Mason market, kind of like the energies on the flip side were recently. And so the charts are just ugly when I'm going through a couple thousand charts every night. I'm just not finding a whole lot, but that's okay. That tells me that maybe I should just sit on my hands and wait for better setups. Okay, I think that's pretty much it for the market. There's bonds, longer term downtrend so far intact there, which is a bit of a bummer for those of you who are looking to finance anything at this particular juncture. You can see they got whacked pretty hard. Off their worst levels, they whacked pretty hard nonetheless today. Okay, let's see what's going on in Facebook. I'm sorry, not Facebook. In YouTube. Okay, no questions. Okay, fantastic. Okay. All right, let's open up for individual stocks. I know in the Facebook group, we're often talking about stocks, and I find we rarely get any picks anymore in the shows, but if there's anything you guys want to look at, I'll be happy to do it now. You guys over in YouTube, if there's anything you want to look at, I'll keep an eye on that chat too. Going once, going twice. Quite a bunch tonight, all right. Well, while we're in impasse, I want to thank everybody for attending tonight. I appreciate you taking time out of your busy schedules to be here. Anything unanswered, david@davelandry.com. Everybody else, you can just ask the questions in the Facebook group. Everybody else that's a member. Okay, stuck at home with COVID-19. Excellent to catch up. Matt from Australia. Thank you, Matt. Well, I appreciate you attending tonight, or showing up on YouTube. And again, I'll do more and more of the YouTube things, and I might just go live outright eventually. But for now, we're going to do the Simulcast. Okay, FDX is a short, FedEx. You know, the transports, that's one thing I didn't look at or show you tonight, I should say. We talked about in the service. You're in the service, so you know that. But you can see transports have been in a pretty serious downtrend, and so far have pulled back, outside day down. So that's looking pretty ugly. I've noticed the trucking stocks are looking ugly, and I'm seeing short set up, but some of these stocks are thin, some of them are choppy, or a lot of them are choppy, and a lot of them have a lot of supply underneath. Bases, for instance, where they might get a little bit of support. So let's take a look at FDX. But I do like a big, thick, well-known company when it comes to shorting, and ideally coming off of all-time highs, like way back here. But this is multi-year high, so I would say this looks okay, but it is a little wide and loose. And the reason I wouldn't take it is you've got a tremendous amount of support down here around 220, 225 or so. So yeah, from here to there, that would be a great little trade, but I like to try to leave things a little bit more open-ended. Let me show you the CEIX, which I think you're short. So this is in the service, and you can see this thing rolled over recently. You got a thrust down, you got a gap down. So this is what I call a reversal gap strategy. The stock tends to trade cleanly, and now it's beginning to crack lower. So this is a great potential short. Okay, I am short this. I'm not short outright. I have options on it, put options on this one, and so far it hasn't worked out. But this looks like a stock that's in trouble. This is the one I wanted to show you earlier. See, all right, FDX. Go back to FDX for a second. Yeah, I hear you, David. Again, it's going to have a lot of support here, but I do like these big, thick stocks as they're just beginning to roll over. I would also, one thing that I've been watching too, and this is too wide and loose and choppy to deal with, but I've been paying attention to some of these prior leaders like Apple. And when these big leaders begin to crack like they did a while back, the market is usually in trouble. Yeah, I'm bearish with you on FedEx. I just don't think it's viable as a short. DUOL from Australia. Okay, well this broke out today, so I'm not sure there's anything to do here. Follow through would be key, and the only problem is sometimes when you get these huge moves like this, it could be a one and done type of situation. So let's see if it could follow through, and then maybe on pullbacks. Amgen, that's going to be a big, nice, thick stock. Yeah, it's not bad. It's probably in trouble, but the way Amgen trades, it tends to be all over the place and a bit of electrocardiogram. I can't argue with you because you got a thrust down followed by a pullback, and you do have supports. Let's see, you're coming off of all-time highs. It just acts like electrocardiogram for the most part. So I'd prefer a stock that trades more cleanly, but I do like the way you think because I do like these thicker, well-known stocks like FedEx, for instance. When it comes to shorting, I wouldn't rush out and short like a thin biotech or some stock you've never heard of, some super speculative stock. But these big, thick, conglomerate kind of stocks, we were short what, KBH, like home builders all. You know, this one, we did get stopped out, obviously, but back here you could see it topped out. You had the thrust down. Let's see if we get a clean chart on that one. What would be a good chart to use? Let's go here. So you can see that topped out. It was kind of a major top in place. I think it was also kind of like a bow tie. And I think we shorted it back here. So it was actually a little bit more obvious of a setup right there, like just coming off of that top. So again, something that trades a little bit more cleanly, and like a home builder, they're not splitting the atom, right? And you can see we got paid in this, but then we got stopped out. You know, it happens, but better than poking out. That's the short side. You get short, you're feeling great, you're going to ride the trend out forever, and then what happens? It goes straight back up. Now, it's not that I don't short. It's just you're not going to get rich on the short side, as I often say, and I got to watch it don't get too negative on the short side. Like I used to say, I used to sail with a sailmaker every now and then, and when light air would kick in or light air wind would die out or whatever, he got really serious. And if you can get a boat moving in light air, you'll win a race. And you're still racing, but everybody's just grabbing a Coke or a beer or a sandwich or whatever and walking around the boat and doing all these other things. So you love light air, and it'll love you. So you don't want to be totally negative on the short side. But the great thing the short side does, as I say ad nauseum, is it helps you to see both sides of the market. If you learn how to pick stocks on the short side, then you'll see sometimes when the stock that you might be bullish on begins to roll over. As I've said quite a bit, I would never throw anybody on the bus, especially these people that I really respect. But I do have some friends that are long only oriented and run a bunch of money, and they always tend to be a little glass half full versus glass half empty when the market gets a little iffy, and they're long only oriented. So I get that. Okay, I'm not criticizing them. I'm just saying that if you are a bit of a trader type and you're looking for longs and shorts, you're going to find that you're able to see when a market is kind of topping out, when a market could be in trouble. And if you can't, then maybe look at something like TFM 10% system and other things like that. Okay, any more questions? Going once, going twice. Well, again, thank everybody for attending. I'll see most of you here that are in my GoToWebinar crowd, we'll see you in Facebook tomorrow. Everybody else, have a great weekend, and we'll see you next week, hopefully. Thank you so much. And may the trend be with you.